Chapter, we're going to begin our discussion of the corporate entity. And while in the last chapter we talked about how most businesses in America are sole proprietorships, corporations produce the most business dollars in America. They house the largest businesses in America. A corporation is a legal entity created under the authority of a state or federal statute that gives certain individuals the capacity to operate an enterprise. Most states follow the Model Business Corporation Act, and the reason that we have these model acts is so that business can be done across the U.S. with similar rules and regulations. That's not to say they're all the same, and that's not to say that each state that adopts the Model Business Corporation Act adopts it word for word. There might be minor changes between states, but generally, business done in Texas is going to be very similar to business done in Oklahoma. It's a relatively young statute. It's been in existence for about 40 years, so it's not quite as settled as older, more traditional statutes like the Uniform Commercial Code or the Uniform Partnership Act. One of the main reasons people form corporations is for limited liability. And we discussed this concept when we talked about LLCs in the last chapter, but limited liability means corporate investors can't be held personally liable for the debts of the corporation. So if you think about a large corporation, say you buy a share of Apple. Well, if Apple gets sued and loses everything, you're only going to lose the value of that share. You're not going to be sued for your personal assets like your house. A corporation is a legal person. It has corporate personhood. It exists apart from its owners. It's taxed directly on the income it earns. So it is a legal person. It can sue. It can be sued. It files its own tax return, things like that. It exists apart from its owners. It's taxed directly on the income it earns. So because of that, it is subject to double taxation. So the corporation owes and pays taxes, and then when the corporation distributes those earnings to its shareholders, that shareholder also pays taxes. So that is one of the major disadvantages of a corporation. One thing that makes a corporation easily be able to raise large sums of money is because ownership is by stock certificate. And a stock certificate is a written evidence of ownership of a unit of interest in the corporation. So it's easy to sell these small share interests and raise large sums of money because no one person, no one bank has to be tasked with raising or contributing all the money. These are different types of corporate entities, major classes of corporate entities. There are different types, but these are the major classes. So first, a private corporation. This is when private people form a corporation to accomplish a task best undertaken by an entity that can raise large amounts of capital quickly or that can grant the protection of limited liability. Most corporations are private corporations, are large corporations that trade on the stock market or are closely held family corporations. They're all private corporations. There's also the public corporation, which is a corporation created by the federal, state, or local government for governmental purposes. And then there are quasi-public corporations. So these are privately organized for profit, but they also provide a service on which the public depends. A corporation is a domestic corporation in the state that grants its charter. We're going to talk about formation in a minute, but a corporation must be formed under a certain state's charter. And it doesn't have to be the state in which the incorporators live. So if I want to start a corporation, and I live in Texas, I don't necessarily have to start it in Texas. I can start it in Delaware. I can start it in California. I can start it in whatever state I want. And you do see forum shopping a lot of times. It used to be that Delaware had the most developed corporate code. Therefore, a lot of corporations wanted to be incorporated in Delaware, even if their incorporators did not live in Delaware. The only rule is that you have to have a registered agent for service in the state in which you incorporate. So, and an agent for service means someone who can accept service of process. So if the corporation gets sued, you have to have someone located in the state that can accept service of process. So if I form a corporation in Texas, it's a domestic corporation in Texas. It is a foreign corporation in all other states. So domestic in Texas, foreign in Arkansas, for example. An alien corporation is one that is incorporated in a foreign country but doing business in the U.S. All right, so alien and foreign corporation are different, remember. Foreign refers to incorporated in another U.S. state. Alien refers to a corporation formed in another country. And a certificate of authority is something that is required for a foreign corporation to do business in another state. A close corporation is one where the outstanding shares of stock and managerial control are closely held by fewer than 50 shareholders. They're often members of the same family. It could also be owned by just one person. There are quite a few close corporations in America. They definitely outnumber large corporations. An S corporation is a corporation where shareholders have agreed to have the profits or losses of the corporation taxed directly to them rather than to the corporation. So here they are trying to avoid double taxation. So every year, all the results of earnings, profits, losses, whatever, flow through to the individual shareholders, so there's only one layer of tax. The LLC is something we talked about in the last chapter, and we'll talk about it in this chapter because it's kind of a hybrid entity, kind of a cross between a partnership and a corporation. And it's a very popular form of business organization right now because it does have some very attractive features. It is a cross between a partnership and corporation. It offers the protection of limited liability to its owners, so you only would lose your investment in the LLC. But tax liability flows through the LLC to the owners. So it has both limited liability for torts and criminal conduct of the LLC, but it has a single level of taxation, so no double taxation. LLCs are statutory, so they have to come into existence when the members follow the steps laid out in the state statute. So it's not something, remember, a partnership, I could just go in business with someone else. I didn't really have to meet any formal requirements. To form an LLC, I do. I have to file a certificate of organization with the state in which I want to register. The owners of an LLC are called members, and the people who run the LLC are called managers. Joint ventures are kind of similar to partnerships, but different because they involve a contractual arrangement by which individuals unite for a limited time to create a new entity in which the founders share control, expenses, and profits. So this is usually to accomplish a task, a limited time to accomplish a specific task. A franchise is a business arrangement that permits an individual, a group of investors, or another entity to lease the right to use a parent entity's business operation, trademark, goods, services, and goodwill under a fee arrangement provided to the parent. So McDonald's, for example, is a franchise. Chick-fil-A is a franchise. We buy a franchise by paying money to the parent corporation, and we pay them usually a fee, and then they also get a portion of our operating revenue. And in return, we get to use the name and the know-how, right? The business secrets in operation of that business. Now we're going to move into formation of the corporate entity. There's a figure in your book that illustrates the steps of that incorporation process. So in incorporating, promoters do the preliminary pre-formation work. So they ensure that the articles of incorporation are drafted correctly and they pay the fees. They engage in any contracts that need to be engaged before it's formed. They appoint the statutory agent, file the articles, organize the first meeting, etc. And we will go through each of these steps. So a promoter is a person who might want to begin a new corporation or incorporate an existing business, and an incorporator is the person or people who actually sign the articles of incorporation and submit them to the appropriate state officials. Promoters and incorporators are often the same person or a group of people, but they don't have to be. Novation is an agreement releasing a promoter from potential liability. So a promoter may need to engage in contracts for the corporation before the corporation is actually formed. So in that case, the promoter is really on the hook for that obligation. So the promoter will often include an automatic release clause in all those contracts. And the release clause does more than just include the corporation as a party to the contract because the corporation isn't legally formed yet. It also specifically releases the promoters from liability. To form a corporation, we have to file the articles of incorporation with the Secretary of State in the state where we want to incorporate. Those articles are the written application to the state for permission to incorporate, and they're prepared by the incorporators. They represent the legal boundaries within which a corporation must conduct its business. So it's like a contract. They typically include the following: the name of the corporation, the duration of the corporation, and a lot of times if that is left blank, it will either be perpetual or some state statutes have a limit. So maybe 30 years, 50 years, whatever. So it's best practice to include a time, and the time can be perpetual, ongoing. They include the purpose of the corporation. And again, this can be general. It can say to accomplish any legal purpose. They include the number and classes of shares authorized to ever be issued in the corporation. So this is usually a pretty big number. Even if it's say it's Apple, it's going to be a huge number, more than they prepare to issue, at least initially and probably in the future. It'll include the shareholders' rights in relation to shares, classes of shares, and special shares. It'll include the rights to buy new shares. So some corporations allow shareholders to maintain their percentage ownership. So if I own 10% of the shares of a corporation, the articles of incorporation might allow me, when the corporation is going to issue new shares, to buy enough, basically to have the first right of refusal on enough shares to maintain my 10% ownership. It addresses its original registered statutory office and its original registered statutory agent. It lists the number of directors plus the names and addresses of those initial directors, and then each incorporator's name and address. Like we said, the articles must have a statutory agent, and that's an individual who is designated to receive service of process when a lawsuit is filed against the corporation. That person has to be domiciled in the state of incorporation. The certificate of incorporation is the corporation's official authorization to do business in the state. So they will file those articles, and when those are approved, they will receive their certificate of incorporation from the Secretary of State, and that will allow them to do business. The bylaws are the rules that guide the corporation's day-to-day internal affairs, and they usually stipulate the time and place of shareholders and directors' meetings, any quorum requirements, which means they can only do business if a certain percentage of directors are there, qualifications and duties of directors and offices, and procedures for filling board vacancies. The articles of organization are for LLCs, and it's the written application to the state for permission to form an LLC. So it's like the articles of incorporation for a corporation, but it's called articles of organization for a limited liability company. If neither the articles nor the operating agreement include a duration statement, then some state statutes set an automatic duration period, just like they did for a corporation, so about 30 years. And then some state statutes set an unlimited duration if neither address the duration. The name of an LLC must include the term limited liability company or those words abbreviated followed by the word limited or the abbreviation LTD. That is just disclosure. We want the public to know they're dealing with a limited liability company. In addition, the name of the LLC can't be the same as the name of another LLC or corporation, just to make it not confusing. The operating agreement for an LLC typically includes formation provisions, operating provisions, the nature of the business to be conducted by the LLC, distribution of profits and losses, the power of the managers, voting rights of the members, etc., It usually includes the same thing that would be included in the Articles of Incorporation for a regular corporation. All right, so when we talked about corporations and corporate formation, we talked about what must be done to form a corporation. If everything has been done properly, the incorporators have followed all the steps, checked all the boxes, that's a de jure corporation. It exactly followed the rules set out by the state incorporation statute, and it is a de jure corporation. There's also a de facto corporation, and that's one where a state incorporation statute exists, it's in effect, and the parties have tried in good faith to comply. They've made a bona fide effort to comply with all the requirements, but maybe they missed a minor requirement, and they have acted as if after they did this, they acted as if they were a corporation. Usually, if only a minor requirement's been left unsatisfied, courts will hold that there has been a good faith attempt to incorporate. Only the state can directly challenge the existence of a de facto corporation. So a de facto corporation has the same rights, privileges, and duties as a de jure corporation as far as anyone other than the state is concerned. So when dealing with the public, if a corporation is a de facto corporation, the public can't then sue for someone's personal home and say, well, they forgot to put the period at the end of the sentence, right? So because of some minor mistake, they're not going to allow the public to sue the shareholders individually. There's also a term, corporation by estoppel, and this one is a little bit confusing because corporation by estoppel does not actually create a real corporation, unlike the de jure and de facto corporation. Instead, it's a legal fiction used by courts on a case-by-case basis to prevent injustice. Generally, it's applied in contract cases, not tort cases. So, incorporation by estoppel, it happens if a group of people act as if they're a corporation when they in fact are not. Any parties who have accepted that counterfeit corporation's existence will not be allowed to deny that acceptance. And then individuals who acted as if they were a corporation will not be able to deny that the corporation exists. So, it can be applied on either side of the contract, right? It can be applied to the individuals who are not actually a corporation, but they act like they are. Or it can be applied to the people dealing with the individuals who are not technically a corporation. And again, it's important to note that this doesn't actually create a real corporation. The next thing we need to talk about is a term called piercing the corporate veil. So, as we've been discussing this whole chapter, one of the benefits of a corporation is limited liability. And most of the time that's going to be strictly enforced. However, if a corporation is basically using its entity in an inappropriate way, courts might pierce the corporate veil. And that is when a court holds wrongdoers, usually the controlling shareholders, personally liable for activities committed in the corporation's name. And personal liability means they can lose more than their investment in the corporation. So this often happens in close corporations. Remember, those are corporations with few shareholders, less than 50. It usually happens to them more than large corporations because the shareholders of a close corporation are often the original incorporators as well as the directors and officers of the corporation, and thus they may neglect to follow the corporate formalities required by the statute and fail to keep corporate property and business separate from their personal property and business. So the court will sometimes find that the corporation is nothing more than the alter ego of the original incorporators. So if you form a corporation, it is really, really important to follow the steps required by the state. So it is important to hold meetings, to hold annual meetings, to keep the property of the business separate from the property of your own, to not commingle funds in a bank account, things like that. When determining whether or not to pierce the corporate veil, there are a couple tests that are often used. One is the instrumentality test, and it says the parent corporation so dominates the subsidiary that the subsidiary has become a mere instrumentality of the parent. So this is when there's one corporation owned by another. So the parent corporation owns a subsidiary corporation, and instead of treating it as two entities, the parent basically treats the sub as part of its corporation. So in this situation, the courts will allow the veil of the instrumentality to be pierced to reach the dominant corporation and to hold that corporation liable for any harm that has been committed through the instrumentality. So a lot of times parent corporations will set up subsidiary corporations to accomplish some business purpose. So they need, say a large corporation needs a new manufacturing plant. A lot of times they'll form a subsidiary corporation that is tasked solely with the objective of building that plant. Okay, and if something happens on that plant, there's an accident, and the person who got hurt, the family of the person who got hurt, sues the subsidiary, they also probably want to be able to sue the parent because the parent likely has a lot more assets. So in that case, if the parent has not really treated the subsidiary as a unique and distinct entity, then courts will pierce that corporate veil and allow the injured party to recover from the parent. There's also the 3-step test for veil piercing. So 1, complete control of the alleged corporate person by the owners. So that would be the shareholders or members in an LLC. 2, the use of that control by the shareholders to commit fraud against the plaintiff. And 3, that fraud has caused the plaintiff to undergo some sort of injury or loss. So here, this is generally not used in the parent sub type of ownership. It is generally used when there's a close corporation and the members of that close corporation do something to cause injury or loss to the plaintiff. A lot of times the courts will pierce the corporate veil and allow that plaintiff to recover from the corporation and also the individual shareholders. Shareholders of a corporation receive the results of operations, receive the results of profits through dividends. And dividends can be paid in anything. We usually think of cash dividends. Here they list cash and stock, but they can be paid in anything. They can be paid in commodity, they could be paid in gold, they could be paid in assets. There's no rule about what can be paid out as dividends. Cash dividends are declared and paid out of current corporate earnings or accumulated surplus at regular intervals. And stock dividends are a distribution of earnings made in shares of capital stock. So stock dividends are, say I own 10 shares, and for every 10 shares I own, I get one more. So I get one additional share, so then now I have 11 shares. A corporation's board of directors has the sole authority to determine the amount, time, place, and manner of a dividend. So there's no rule that says corporations have to ever pay out dividends. Typically, the director's declaration of a dividend sets a cutoff date, which is the date by which a shareholder must hold corporate stock of record to receive payment. All right, and we know that a corporation is owned by stockholders, and there are 2 general types of stock that we're going to discuss here. There can be many different classes in these 2 general types. So one is common stock, the other is preferred stock. Common stock carries with it all the risks of the business inasmuch as it does not guarantee its holder the rights to profits. So I like to think of common stock as the residual ownership. Common stockholders get the very last. They are paid out very last in the event of corporate liquidation. They get what's left over. That can be good or that can be bad, right? If the corporation has been wildly successful and they get what's left over after the employees have been paid and the liabilities have been paid, that's going to be a lot. There's going to be a lot left over. But if a corporation is being liquidated because it's bankrupt, there's going to be nothing left over. Common stockholders are usually entitled to 1 vote each for each share of stock held. The most common type of corporate stock is common stock. And common stock carries with it, like we said, the risks of the business. The holders of common stock are paid dividends when the corporation elects to make such a distribution. And the holders of common stock risk whatever they invest, but again, they have limited liability for anything over and above their investment. Preferred stock is classes of stock that have rights or preferences over other classes of stock. So those preferences usually involve the payment of dividends, which means they get paid dividends first before common stockholders, It also usually involves a preference as to the distribution of assets on the dissolution of the corporation. So again, they get paid first before common stockholders. That's why I said common stockholders are the residual owners of a business. All right, and the dividend payments can be cumulative or non-cumulative. And what that means is, remember I said with common stock, there's no right to receive dividends at any predetermined time. Well, with preferred shareholders, there might be. So the preferred shareholders might receive a $10 dividend per share per year. Dividends aren't a liability until they've been declared by the board of directors. So if in 2019 the board of directors never declares a dividend, and I'm a preferred shareholder, I own one share, and they never declare a dividend, I don't get my $10. So next year in 2020, if they declare a dividend and my shares are cumulative, that means in 2020 I have to receive the $10 I missed in 2019 and the $10 from 2020 before common shareholders receive anything. So in that case, in a cumulative preferred share system, I would get $20, okay? In a non-cumulative preferred share system, I would only get $10. That means I don't get any dividends in arrears. That's what it's called, dividends in arrears, dividends that haven't been paid out in the past. I don't get those in a non-cumulative system. So in a non-cumulative system in 2020, I would only get $10.